Okay, welcome back. Hey, look, it has been a crazy couple of weeks at home and at work for me. So I have been letting some of the investing just compound. I've been collecting some lovely little rent checks as well from properties such as real estate investment trusts, as well as just regular dividends and other distributions and interest payments. So look, today I just wanted to have a quick chat about Essential Properties. It's similar to Realty Income and Agree Realty in my portfolio, so there's quite a bit of overlap, but I want to just quickly scroll through the March 2024 presentation from about a month ago to really look at what is making this distinct and why I have a place for it in my portfolio today. So yes, disclaimer and all this sort of good stuff. Fundamentally, one of the key things here is just an absolutely fabulous, stable portfolio. Their tenants have good rent coverage. Now, unlike companies like Realty Income or Agree Realty, the EPRT team, they focus on smaller tenants. Now what that does mean is that they do a lot more due diligence. They're not focused on investment grade tenants. Instead, they do the legwork to assess the tenant's trustworthiness and creditworthiness themselves. And so there's some opportunities there, and that can lead to faster growth and a stronger portfolio. Now, of course, all of this is when the job is done well. And I think from this presentation as well, and from the past results, I think we can see that this team is operating very effectively. So they've got a good balance sheet strength. They've got a pretty good asset base here. They've got low amounts of leverage, so below 4 times, which is, I think, very good and safe. One of the beautiful things here as well in the current environment is this well-laddered and low-cost debt, which has put them in a very good position in the last year or so. Now, I think this is an important slide here, and this is really focused on what they do and how they do it. So small scale, fungible, net leased properties. So this is in their wheelhouse. They're also looking for service oriented and experience based industries. So really being resistant to this idea of e-commerce, being focused around need for the clients to have customers visiting that location. So the tenant's customers have to be there to experience what the tenant has to offer. Now that gives them some resistance in this age of e-commerce and digitalization. Now they've also got this middle market business here. So again, we're talking about smaller companies with less access to capital and credit over different periods and different types of companies, and so EPRT is filling a need here as well. Now this ultimately leads them down to this final point here, these attractive risk adjusted returns that they can experience. Now this is also I think quite important as well, so relationship based sourcing, so there's a lot of repeat business here. So we're talking about, because of the life cycle here, we're talking about some very long-term, multi-year, multi-decade relationships. Now, the underwriting methodology, so this is the legwork that they're doing. So they're doing very careful evaluations of the actual real estate. They're trying to understand the business itself and how profitable it's going to be, and particularly looking at things such as the rent coverage ratio, as well as historical financials. They do take this overall industry view as well. So if you're thinking about, for example, that e-commerce resistance element is important, so they don't want to be stuck holding a whole load of real estate that's geared towards a particular industry when that industry is going out of business. And of course also looking at the creditworthiness of the tenant as well. And so these are all sort of different pieces of the puzzle represented here, and this is what makes this a powerful investment platform. So who exactly are their tenants? We can see here that there's quite a huge amount of industry diversification. Now they have focused on 16 industries, and we can see again just on the next couple of slides as well the high level of diversification here, and also diversification in terms of tenant and in terms of the percentage of the cash ABR Their portfolio isn't entirely diversified all over the United States. It's definitely more concentrated here towards the east. But again, we see some exposure here to some fast-growing regions such as Texas and Florida, which have seen strong inflows in terms of population growth and economic activity as well. So all of that should, again, at the fundamental level, be positioning this company for some really great opportunities. Now, the leasing and the increases annual rent escalation, they've got a 1.7% here. I think this is slightly higher than, for example, Realty Income. Most of their rent escalation is contractually fixed this way. A very small sliver is CPI based, and a very small sliver is in fact flat or no escalation. So we're talking about a reasonable level of rent escalation here. So under normal circumstances, with normal levels of inflation, that would be quite attractive. Now, a big part of what they do, as noted, is this idea of disciplined underwriting. So huge investigation. So if you're thinking about this in terms of being a detective, this is the sort of information that they want to dig out. Now, they do look for the tenant financial reporting requirements, and as you can see, most of their tenants have to have a fairly high level of financial reporting here. Now, that enables the Essential Properties team to really zero in on some of these key elements here that help them to decide whether or not this is going to give themselves as the REIT a strong tenant that's going to be able to be there through thick and thin and continue to pay the rent. Unit level coverage by tenant credit, so they don't have so much the A level tenant credit. Most of it's down here into the solid Bs as well, and you can see the rent coverage ratio tends to be quite strong here in the darker colour. That tends to be the higher proportion. And I think this is also important as well, the unit level coverage by lease expiration. So when you look at this in the next 4 years, there's a very small percentage of their overall leases that are going to be expiring. Now what this means is it gives us some stability here in terms of what we can expect from AFFO moving forward. Basically, is the earnings just suddenly going to drop off the cliff? For example, if they had a big spike here in terms of the lease expirations in 2024 or 2025, given the current economic circumstances, or if you're moving into a recession, it may be possible that they cannot, for example, release those properties at the same level. Now, that would mean to the AFFO and a little bit more uncertainty here. So in the near future, at least, they've got this good range here of a fairly low and fairly consistent level of lease expirations, which I like to see. Now, overall leverage and liquidity. So you may have heard me talk about this. First of all, though, I want to just look at the consistent use of leverage here. It's been a little bit high coming out of the pandemic, but what they've been doing is they've been gearing that down. So they've been reducing this down to about the 4 times debt to EBITDA. And I think that's going to be a fairly safe, reasonable level for this type of company. But also looking over here, for example, in the debt maturity schedule. So are they going to be whacked with a huge amount of debt that they have to pay off suddenly, quickly? And we can see, in contrast to some of the REITs and some other companies, there's nothing really here in 2024, 2025 at all. And then 2026, they have the revolving credit facility availability is up for renewal there. And I don't think that's going to be a substantial issue as well for them, given their very careful and considerate use of debt. What we see here is essentially they have no debt maturities. That's really going to put them under pressure here until February in 2027. One of the cool things here, the things that I really like to see, is this adjusted funds from operations and the growth in this AFFO. Now, the AFFO for a REIT is basically their earnings, and what we can see is generally some really powerful growth. Now, I want to just switch over here to the peer comparison, because I think this also gives us some really good insight. Now, what we're looking at here is some of the key peers in the sector, and for example here, service-oriented and experience-based industries, so these should be the less able to be disrupted, say, by digitalization. And so we can see that they've got a high proportion of their tenant base here in this yellow bar. They've got less reliance on the top 10 tenancies, so the less concentration risk. Now, if you're thinking about why I might be interested in that, I was burned by Medical Properties Trust, which had a huge reliance on a couple of key tenants. And so here, this is more diversified, and if something happened to one of those tenants, it's going to have less impact overall on Essential Properties. Unit level coverage and transparency. So most of their unit level financial reporting comes through most of their tenants. So they've got great visibility on what is going on as well, and some fantastic numbers here as well in terms of the rent coverage. Lease maturities, so a very small amount of the leases actually expiring through 2026, particularly compared to some of the other tenants, some of the other peers that they have here as well. So what I'm seeing here is some really nice metrics here in the net lease sector. They're not the most powerful company here, but I think they're doing very well when you look at some of these metrics. Now for me, this is one of the key things here that I really want to see. So when we're looking at the AFFO per share multiple, this is like the price to earnings multiple. So it is one of the more expensive ones in the net lease sector. Is that a good thing or a bad thing? I think one thing it does reflect is this fairly strong and powerful expected AFFO per share growth of 5.6%. Now that is definitely sector leading, and not by a small margin either. And so what we can see here is when many other companies are looking at AFFO for about 3%, Essential Properties is almost double that. Now, is that a good thing or a bad thing? Can they keep this up? Is this consistent? Yes, broadly, this is going to be fairly consistent over time. They've done a very good job of growing the AFFO. So when we're thinking about this in terms of the net lease sector, this company is a strong grower. Now, the other beautiful thing about it is their very careful management here of debt. So we can see almost sector leading here. One company here very much is an outlier. But otherwise, what I like to see here is a smaller amount of debt than some of their peers in the sector. And so for me, this is really important. So what am I seeing? Relatively low levels of debt, relatively high, essentially the earnings growth here, and reasonable multiples that they're currently trading at. All right. Now what I've done is I have switched over to FASTGRAPHS. Now this is my charting general purpose quick visual check on a company platform. This is the one I love to use. I've made a couple of really nice improvements lately. For example, now that I am switched to EPRT, Essential Properties, it's a real estate investment trust, a REIT, it's automatically switched here to the adjusted funds from operation. So essentially looking at the core measures here that I'd be looking at for a REIT as opposed to an industrial where I'd be looking at the earnings per share. Here I want to look at the adjusted funds from operation and how this is growing instead. So when I look at this, there's a couple of key points to look at. We can see here short history relatively. If we ignore that sort of first year where things sort of got going, we can see into 2020, obviously with pandemics and things, it's a bit of a shocking year to really get started. And we saw a drop there in AFFO growth. We saw a couple of really strong years here of 20% and 14%. This year about 8%. Now it seems to be dropping off into mid to high single digits, I would expect, over the next several years. So we're talking about growth here of at least 5%. Now add to that dividend yield of just under 5%. We're talking about probably about 10% growth at this particular multiple here. Now it's bang on this orange line, which represents a 15 times price to AFFO, which is more or less like a 15 times price to earnings, a reasonably fair value. Now it's also got plotted here this blue line, which is suggesting that since this company's traded, it's been trading at about 18.5 price to AFFO, so we might even expect prices to trade up to this level, and obviously at times it may even exceed this level in the near future. What does all this mean? It means I would expect the underlying adjusted funds from operation, the AFFO, to grow at 5% at least per annum. Throw on top of that the 5% dividend yield, and I'm assuming prices more or less track the AFFO or earnings growth. And so essentially the value of my investment should increase by about 5% plus about 5% from dividends, about 10% per annum, and that's what I'm looking at. Now scrolling down here, they've got a couple of really cool things on here as well. One of the nice things about the analyst scorecard down here is 2 years forward, the analyst estimates for what the AFFO will be have been accurate 100% of the time. Now, obviously, there's a sort of a margin of error here, but more or less the company's providing good guidance. They're well managed, they're stable, they explain what's going on. The analysts can anticipate what's going to happen 2 years out with the AFFO changes, and so we can broadly say that these expected AFFO changes are what we are likely to see, and for me, I'm loving it. A couple of changes. I'm going to change over to the overall performance here, and what we can see here is we can see the charts at the top, and as we come down to the bottom, it's got this tabulated view. We can see the dividend growth. It's been fairly strong. It's been a little bit lower this year at 4%. I would expect the dividend growth to be more at this 4% per annum growth moving forward in dividends. So it's not going to be a sort of a super compounder in terms of dividend growth. I don't anticipate this, but I do anticipate the roughly 5% dividend yield at the current cost basis, plus a little bit of dividend growth, plus of course that increase in the AFFO over time. Now, in terms of the forecasting, it's always hard to tell what your return's going to be. I do believe it will trade at higher than 15 times in the price to AFFO. I'm not confident it's going to trade up at 19 times. Now, FASTGRAPHS gives me quite a bit of flexibility here. I'm going to select about an 18.4 times. I can see out to the end of 2025, there's 11 analysts reporting. So I'm going to pick this. So if prices return to this multiple, which, and of course, this assumes that the AFFO estimates are roughly accurate, I'm talking about a total annualized rate of return of about 22% per annum. Now that is comprised of dividend, collecting the dividends. It's also comprised of this increase here in the AFFO levels. It's also comprised of prices actually beginning to increase up to this ratio, this price to AFFO ratio. Is this reasonable? I think it's reasonable. Yes, prices can go down from here, but I do believe this is a well-managed company. I do believe that AFFO growth is relatively strong, and it's also something that they can keep up. I love the relatively low levels of debt here, and so for me, I think this is a company that I will continue to invest at as long as it's trading, I think, at these reasonable levels of about 15 times on a price to AFFO basis. If it dips down here, very opportunistically, I'd love to buy more at about that level. Is it going to happen again in the future? I don't know. But every now and then, I'm definitely going to be adding to this position as it sticks around this 15 times price to AFFO level. Let me know down in the comments below, what do you think? Is this on your watch list? Is this one that you're looking at? If not, why not? And do you have other REITs that you prefer more than this one? Let me know. I'm very keen to hear your thoughts.